Should you buy the dip in Airbnb stock that is down more than 16.5% in the after hours on the heels of reporting their Q2 print? In this video, we will go through not just their Q2 numbers, but especially the Q3 outlook that this company provided, which is, spoiler alert, the reason why shares are falling in the after hours. We'll also go through the growth rates on some of their KPIs, showing you that this company is coming to a very, very small growth rates. And especially we'll question whether its valuation, which is still not overly expensive, can it be justified as this company heads into a slower growth rate environment. Also, we'll take a look at some extended risks that maybe 4 years, 5 years down the line, Airbnb can see with its long-term business model and see how those will impact this company. We'll get into all the financials and then we'll take a look at the technicals. You definitely want to stick around for this part, as shares of Airbnb breaking through pretty much any level of support that it had underneath itself, as shares are falling more than 16% down to $108 in the after hours. Hey guys, hope you're doing well out there. It's time to check in with shares of Airbnb that are down nearly 8% year to date, down another 14.5%. I'm seeing as much as down 16.5% in the after hours. Yeah, that'll bring your year to date declines pretty close to down 20%. You're also breaking through your 52-week range, now coming in underneath $113. So keep in mind, this company is going through some rough periods. We'll really look to break down these numbers and make sense for that for you. Now, in terms of a valuation, keep in mind this one is trading underneath 28 times. Probably tomorrow will open down around 15%, and so maybe that valuation will be coming down to close to 25 times a forward earnings multiple. Keep in mind, not overly expensive, but as we walk through these results, not overly cheap either. Now, in terms of their Q2 revenues, that came in at $2.75 billion, growth of 11% year over year, beating expectations right around 10 million, basically in line with what Wall Street was anticipating. The Q2 GAAP EPS came in with a miss, however, at 86 cents a share. Estimates were near 91 cents a share. So they came in with a bottom line miss. Now, that's not enough to send shares down nearly 14%, but what is enough is a pretty bleak outlook, and especially comments regarding the overall slowing demand and the sequential moderation that this company is expecting. So in Q3, they're expecting revenues to come in between 3.67 up to $3.73 billion. That would be growth of right around 8 to 10% on their midpoint. If you take growth of right around 9%, keep in mind that is well short of analyst expectations, which were near 3.84 billion. So analysts were expecting nearly 13% growth for the upcoming Q3, Airbnb guiding for nearly 9% growth, so a full 4 percentage points lower than the midpoint on Wall Street. So that is red flag number one. That is cause for concern, and that is what is sending shares down, that you're expecting Q3 revenues to come in lighter than what Wall Street anticipated. And keep in mind, there's some pretty big events going on. There's the Paris Olympics happening over in Europe, where you probably have a lot of foot traffic and a lot of short-term rentals, and despite that, you're still expecting an 8 to 10% growth. That is, again, underneath what Wall Street was anticipating for the current Q3 we are in. That will include the summer holiday travel season as well as the Paris Olympics that are probably, again, bringing in a ton of bookings, at least in the city of Paris, if not overall in Europe as well. But this company also is saying that they expect a sequential moderation in the year-over-year growth rates of nights and experiences booked relative to Q2. So to put this into perspective, in the most recent Q2, they saw 9% growth on their nights and experiences booked. This is basically their key metric, telling you how many nights or how many essentially stays people are booking on Airbnb. That came in at 125 million nights and experiences for the Q2. Again, year-over-year growth of 9%, which is not terrible, but especially when you compare it to their prior quarters. Look, in Q2 of 2022, they were growing at 25%. Then that slowed to 11%. Now that has slowed down to single digits and 9%. And they just guided that they're expecting sequential moderation in the year-over-year growths in those nights and experiences booked. So instead of 9%, they might see only 7% or 8% in the current Q3 we are in for the nights and experiences booked. Now, what they do say, they do expect average daily rates to increase modestly on a year-over-year basis, and that's really what we've been seeing. The average daily rates, basically the price per average night on a stay at Airbnb, rising up to $169, which was, again, just growth of 2% year over year, and that's really what you're expecting for the current Q3. So maybe if you see another 2% growth on your ADRs and then maybe 7% growth on your nights and experiences booked, that gets you a number close to 9% on your gross booking value, which basically translates nearly dollar for dollar into your total top line revenues, which again, Airbnb expecting for around 9% growth on that Q3 revenue side. Now, they did also say that they expect those margins to take a hit in Q3, as they're expecting declining margins relative to, I guess, a year ago, And that is due to marketing expenses growing at a faster clip than the revenues on a year-over-year basis. So not only are your revenues slowing down in their growth rates, you're also expecting to take a hit on your EBITDA margins as you expect your marketing expenses to outpace the growth on your revenue. Some things we certainly do not like to see, as this company is just slowing down from that revenue side, which is very, very important for a platform, for a network-based company like Airbnb. When they just strip off a little bit from those gross booking volumes, anytime you get a slowdown in the growth rates of those gross booking volumes, that translates perfectly into a slowdown into your top line revenues, because this company really has no other means to accelerate revenue growth other than increasing their total nights and experiences booked. So keep that in mind. This company quite one-dimensional in that fact that as their nights and experiences slow down, their revenues will slow down, and they really have no other way to continue to increase that. And so that really brings into question the upcoming Q4. Will they be able to do nearly 12.5% growth in the Q4? I highly doubt it, probably closer to 10%. And then following Q1 and Q2, probably closer to 8 or 9%. Again, year over year, slowing growth rates on the revenue side. And what I want to point out is a company like Booking.com, which again has similar growth rates on the sales side, around 7 to 9% on that top line growth. They're trading at right around 5 times a trailing 12-month price to sales. Now, keep in mind, Airbnb trades closer to an 8 times trailing price to sales. So as their growth rates slow down, your price to sales should also come down. And for a company that trades in a similar revenue growth ballpark, their price to sales are actually significantly lower at 5 times instead of 8 times. So I expect Airbnb's price to sales also to come down near 5 times, and certainly a 15%, nearly 16% decline in the after hours will absolutely have that happen. Now, in terms of long-term risks, I think this is a key risk, if not the only risk, and the only reason why I stay away from Airbnb stock is the fact that how will regulation really affect this stock in different parts of the world as we look ahead 2, 3, if not 5 years. And certainly we got a little bit insight into that last week when Barcelona announced that they were not going to renew any tourist apartment licenses that will set to expire in 2028. And so what that does is companies like Airbnb, other companies like Vrbo, which is owned by Expedia, those companies that rely on the short-term rentals by apartments that are owned, again, by people that probably don't live in Barcelona, but allow their apartments to be rented out for tourists. If those cities choose to not renew any short-term apartment licenses, or let alone they ban short-term rentals altogether, that will certainly impact a company like Airbnb that can no longer do business in Barcelona maybe 4 years down the line after 2028 when those apartment licenses expire. And so the reason a city like Barcelona would do this is because they need to expand the housing supply for full-time residents, and they certainly have housing emergencies for the locals, for the full-time residents that live there, simply because real estate prices and rents have been skyrocketing due to an increase in demand in short-term rentals. So people are certainly buying property in places like Barcelona, just renting it out because they know that they'll frankly get a good deal from their tourists that are entering that city, but that means there's not enough housing supply for the locals, for the full-time residents. And so this is not just isolated to a city like Barcelona, it's actually also happening in other places around the world, as Airbnb was limited to new reservations in New York City as short-term rental regulations go into effect there. Certainly we know in New York City there's a big housing crisis and rents are simply through the roof, and Airbnb has certainly contributed to that, as simply their short-term rentals have increased meaningfully over the past couple of years, especially since COVID. Similar situation we're seeing in Maui, as they have a housing shortage and now officials are limiting the tourist Airbnb rentals. And so this really is a long-term headwind, I'd say a long-term risk that Airbnb comes with, is these companies like Airbnb, like Vrbo owned by Expedia, need to navigate so many regulations in so many parts of the world in order to have their business just be allowed to operate in those cities. I think that is a key challenge, or really a key risk in terms of investing in Airbnb, simply because if they're no longer allowed to do business in a city like Barcelona, well, they'll simply lose revenue from that geography altogether. Now, keep in mind, if this long-term risk does not materialize and Airbnb can maybe find a workaround, or they're able to continue to do business in Barcelona, well, then yeah, that risk is simply taken out, and I think that will allow the stock to move significantly higher. But if that risk does materialize, then yeah, I think Airbnb business model will certainly come into question and be under a ton of pressure in many different geographies. Now, despite those long-term risks certainly being intact, this company is doing quite a few right things in the near term, and that is growing their quarterly free cash flow at a pretty nice clip year over year, up 16% Again, that's on a quarterly free cash flow coming in at north of $1 billion, now representing 38% of their revenue. So they're also growing their free cash flow margins along with growing their free cash flows on a year-over-year growth rate. That is a combination we like to see. Now, in terms of a trailing 12-month free cash flow coming in at $4.3 billion. Keep in mind, this company is valued right around $70 billion once you account for the after-hours decline. Again, $70 billion, and they're producing right around $4.3 billion in free cash flow. That's for the last 12 months. Certainly not bad from a free cash flow yield perspective. You're looking right around 6%. And keep in mind, your free cash flow margins also staying relatively flat to slightly increasing at 41%. Now, you might be asking what this company is doing with all that free cash flow. And yeah, here it is. They're buying back their common stock to the tune of nearly $800 million in the most recent quarter, bringing down those shares outstanding, both on a common basis, but also bringing down those fully diluted shares, which are really what matters, especially once you account for stock-based compensation. So this company has a $6 billion buyback in place. They've used, I believe, around $1 billion in that. So they still have a long ways to use that buyback. And certainly from a free cash flow perspective, we'll see this company generating just a ton of free cash flow, which they'll put to use in that buyback. So from that perspective, you are getting good value from a free cash flow perspective. Now, in terms of statement of operations, we have that revenue growing right around 10% up to $2.75 billion. That's the headline top line figure that we got from Airbnb. Now, what's not good is they're raising their costs and expenses in line, if not faster, than their overall revenues. As you see, cost of revenues coming up to $500 million, operations and support coming up to $338 million, product R&D also year over year ticking up, sales and marketing ticking up quite substantially, nearly $100 million increase on that line, and then your G&A also coming higher at nearly $315 million. So your total costs and expenses ballooning more than 10%, and so your income from operations, despite raising your revenues by nearly 10%, you actually generated less in your operating income than you did same time last year, coming in underneath $500 million for the most recent quarter. Now, keep in mind, when we come down to their income before income taxes, otherwise known as EBITDA, you actually see this number is higher than it was a year ago, and that's because they have a ton of interest income coming through the bank as they're holding a ton in cash and cash equivalents. So I'd say for a company like Airbnb, I actually would stop at a line like income from operations, as that really tells you how the underlying business is doing and strips out the interest income or interest expense that they pay on their boatload of cash on their balance sheet. So from just an operating income perspective, the fact that your operating income is down year over year despite raising your revenues nearly 10 to 11%, I think is cause for concern. On top of that, in your outlook, you got that this company saying marketing expenses, again, is expected to grow faster than revenues, and EBITDA margins will likely decline in Q3. So again, they're giving you guidance that probably the Q3 margins won't be as nice, and so they'll probably come in again lighter in terms of operating income than they did a year ago. So while this company is growing their revenues at just high single digits, they're having to spend a ton in marketing expenses to just do that. And probably if they weren't spending that much in marketing expenses, their revenues might actually be flat on a year-over-year basis. So that's not good to see. This company not able to grow without growing those marketing and sales expenses. Now, what this company does have going for itself is its balance sheet, as you have cash and cash equivalents coming in at nearly $11 billion. Again, for a company valued right around $70 billion, having nearly $11 billion in cash and short-term investments, certainly a good look, as you're not having a ton of concern from just a balance sheet perspective. On top of that, your total liabilities not a whole lot, as your long-term debt coming in underneath $2 billion. That is, again, good to see this company well capitalized from their balance sheet. And then again, like we said, from a cash flow perspective, paints an even better picture, as on a 6-month basis, your total net income coming in at right around $800 million. That turns into nearly $3 billion in operating cash flows, as they get to add back quite a bit in stock-based compensation. They also get to add back something like unearned fees, which they have to account for as a liability on their statement of income, but it's not actually cash leaving the business. So they get to add that back in here, making their operating cash flows look a lot juicier than probably they really are. So nearly $3 billion in operating cash flows over the last 6 months, and they simply don't have a ton of capex, as this is a asset-light business. It's a platform that relies on a two-sided network, so it's not like they're owning those Airbnb homes, and they simply don't have a ton of capex, and so they can put nearly $1.5 billion of that towards the buyback of their common stock. So this company generating a fair amount of free cash flow and putting that towards their buyback, like we saw to reduce those shares outstanding. They simply haven't been public for a long time. So if you stretch it back further, yeah, those shares outstanding probably won't make any meaningful sense. But since they've gone public, those shares outstanding have been going down due to that big buyback that they have in place. So I think that is your bull case. This company generating a good amount in free cash flow, nearly a 6% free cash flow yield when you exclude stock-based compensation, and that they're using towards their buyback, which I say they'll likely continue doing for the foreseeable future. But I think you have some certain long-term risks with this one, especially with regards to what regulation looks like in different parts of the world, and will they be able to continue to operate their business in all those regions, which I think is a certainly big risk that you have to consider when taking a look at Airbnb, and something as a risk that probably doesn't come into effect or nearly as much into effect when you compare it to other competitors, like especially a Booking Holdings, which again operates more hotels through their platform rather than short-term rentals like homestays. So keep that in mind as you compare something like Airbnb and something like Booking. Now, from a technical perspective, there's a lot of things not to like here, as you're breaking through multiple levels of support. You broke through this support at nearly $130 a share. You again broke through a support at nearly $115 a share, and chances are you're probably coming down, call it to $100 flat, as you have a line of support right here at $100, $300, and $4 from back in May of 2023. So you're breaking through all of that. You're probably going to gap down tomorrow and open significantly lower, and then I'd say you're probably finding some support close to $100. Underneath that, you don't have a ton of support. Like we said, this company not having been public for a very long time, and so if you break this $100 level, you're probably coming in somewhere underneath $90, and again, not a whole lot of support at that level. Probably everyone owning their shares of Airbnb will be underwater, maybe looking to hit the exit button at that point. So certainly could be a capitulating sort of trade over here, but for now I think this one is a falling knife, and one I would actually stay away from until it finds a meaningful level of support somewhere, I'd say in the $100 range, because you certainly don't know when this one will bounce. You probably don't want to try to come in here and pick the bottom. If you do pick up shares of Airbnb at this point, I would set very tight stop losses from where you do pick it up, because you do want to get stopped out of a position like this if it continues to head lower. From a free cash flow perspective, that is what the bull case argument will be. This company looking extremely cheap, especially after this after hours decline. Also from a balance sheet perspective, you have a lot of safety baked into this name from their cash and cash equivalents pile. But you do have some significant long-term risks to this name that I want you to consider if you are thinking about investing in Airbnb. Also on top of that, keep in mind, as the growth rates continue to slow to the high single digits for the foreseeable future, that price to sales also should come down, I'd say more in line to something like Booking, closer to a 5 times a sales from that perspective. That was my take on shares of Airbnb, one I actually do really like from its asset-light platform-based network system, but one I do stay away from simply because of this long-term risk. I don't know how they'll manage their business in all these different geographies that continuously have different regulations. So this is one I'm staying away from for now. I do have on my watch list, and I'll continue to track it, especially as the valuation continues to head lower. Maybe at one point could be worthwhile opening a position in, but for now, it's a no buy for me. That was my take on shares of Airbnb. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.